Wow.
I feel like we have some initial thoughts on the video.
Yeah, I think the pronunciation of Saint-Hermenegilde was very difficult for the guy.
Poor announcer. Well, Dan, it's great to have you here today. Thank
be
you
here.
for joining us. I'm sure a lot of the crowd here knows who you are, the audience online and in the room, as you have been with Fidelity for a very long time now, really making your mark.
Not that old.
In a great way,
Yeah,
in a
okay.
great way. But the last time we spoke was back in May, and you were having a lot of fun. And I think that fun might have been stemmed by an event that Sam, Morgan, and Naveed were just referencing, which was Liberation Day.
Yeah.
We're going to get into how you're feeling today, a few months post that. But before, just to kick everything off, because there's a lot of fun places we can go with your style, your portfolio, your positioning, let's maybe start with your process and really just laying the foundation to then leapfrog into a lot of fun topics.
Yeah, and to explain what I did this year, which was
Make it all make sense.
a lot of movement. Yeah. So to summarize, like you said, most people kind of know the process by now. Hopefully, if you're invested in Canadian large cap, you've heard it several times. But obviously, try to protect capital, so try to protect downside. That's the overarching goal of everything I do, and then try to maximize upside once that's taken care of. And we do that by investing in companies who have a combination of hopefully the best balance sheet possible, best management team possible, best return on capital possible. You can't get the best of all worlds all the time, but I certainly try to, have a higher quality portfolio than average. The next point has turned out to be the most important one. It's being patient. The patience to let the market come to us for prices and valuations to get to a level that are attractive to us. And then, harvest these things several years down the road once the market has recognized all of that. And finally, not trying to paint myself in a corner, not predicting the unpredictable, and embracing my ignorance, as I like to call it. So what we try to do here is, in this process, is not to predict interest rate, currency movements and inflation, but really, or commodity prices for that matter, but let them come to us and wait for opportunities where it's just basically a no-brainer, where you don't need to be that smart to invest. So if you have the patience to get to these places, then returns are going to be quite interesting. But as I said, the most important part of all of this is to have the patience to let different securities or sectors get to the price you want to pay.
And I think that word patience, people have heard from you for many, many years. And we saw that come to fruition in April. So let's touch on Liberation Day, because I think that was a huge catalyst to 2025 and what we've seen and then where we're at today. Maybe touch on for the audience what happened. So Wednesday, April 2nd was Liberation Day announcement. I know that weekend for you was very busy.
Yep.
I'll let you tell the story, but just going back to the strength of Fidelity and what you were able to do because that patience paid off.
Yeah, so what we do obviously is, as was said in a lot of presentations up to now, including the previous one, is you need to be ready for these events. You can't just show up that day and just try to think about what we should buy. So our analysts around the world meet with companies every day, every week, every month. And so I have an understanding of where they stand, what my watch list is. I have discussions with them. I travel the world, et cetera, so that on that particular week, we know how to react. Because let's be honest, Liberation Day was a little bit of a different angle from anything we'd seen. It was a little bit more aggressive than we expected. We had prepared for what Trump was going to come out with, but it really wasn't exactly what we expected, obviously. So that really rapid reaction time, knowing your businesses inside out, was really, really helpful. So to add to the urgency on the Friday, as all these stocks were hitting my price points, I had been sitting on a lot of liquidity. I had that patience that I talk about, which is really important for this process. We were ready to deploy. So I was ready to invest a lot of money. I set up this internal chat with all the Canadian and US analysts, which I called Tired of Winning Chat. And for many weeks, a lot of these analysts thought I was talking about me, whereas obviously it's kind of this Trump quote, but it was really efficient as they were just shooting ideas at me, and all the analysts were getting involved as well, right? Because some sectors are really just adjacent, they're really close, they impact each other. So at the end of that day, the trading sheet showed that I had bought over $1 billion of securities. You sell arbitrage, you sell bonds, you sell other things that are less volatile, staples and things like that. And continued over the weekend, like you said. So bought a lot of financials in Asia, a lot of Japanese banks and insurers, and then overnight also bought a decent amount in Europe, such that at the end of the day on Monday, April 7th, I believe, Canadian Large Cap Fund was fully invested.
Wow.
No arbitrage, no bonds, no cash. Not crazy aggressive. We were still, following the process, and I still thought that we weren't at a place where the portfolio should be much more, cyclical, but we were fully invested.
It's exciting. I have two follow-up questions to that. One, how many hours did you sleep that weekend?
On the night from Sunday to Monday, I slept about an hour and a half, because Asia is open from 8, and then I punched in my trades for Europe before it opened, and then woke up for kind of the European Open.
Wild, absolutely wild. And then the Tired of Winning chat. I love the name, by the way, but is that still going? Are people still excited? I'm sure the analysts learned a lot from that chat.
Good question. I've sent the analysts a few thoughts 2-3 times.
Okay.
But nothing else. But I'm hoping for that chat to be live again soon. Let's hope for some volatility.
There you go.
We'll be busy.
Fire that back up. That's perfect. So that's a great, way to set the stage for where we are at today. So we're entering Q4, and we've seen the markets rebound quite a bit actually since April. And there's been, some dispersions that potentially have created some entry points. Yes, no, that's what we're going to get into. But how are you positioning the portfolios to take advantage of the current environment while still looking at risk that's on the table?
I would say, to be completely blunt, the positioning right now, if we want to start there, is the most defensive I've ever had. It's a bit more defensive than January, February this year. It's more defensive than January 2020. It's more defensive than the fall of 2018. So I'm really struggling to find ideas. That's basically the conclusion here, because I read all of our internal research every day. I get 3 research packages from our analysts, one for the Americas, one from Europe, one for Asia. And I try to look for ideas every day. They know my process, so there's a lot of discussions going on. I meet with companies as well that are close to my price point. And it is getting really difficult. If we go back 1 year, if you always look for ideas, there's usually quite a few that pop up. We had quite a few in emerging markets last year. I owned in Canadian large cap. I owned a Brazilian brewer. I owned a company in Japan, also in the spirits industry. I owned a company in South Korea in the tech industry. And I owned a bit more European stocks. I was more involved in China. And in the last year, everything's kind of floated up in valuation. There's less attractiveness, less margin of safety. So for me, it has meant just trimming here, trimming there. Like today,
that was going to be my question. Are you still holding those, or have you?
So I'm out of Brazil. I'm out of Japan. I'm out of South Korea in Canadian large cap fund. I'm still in China. There's still a few percentage points there. I'm quite heavy in Europe. That's the place where we have a lot of investments. I would say the U.S. specifically, the divergences are interesting, right? We've seen a lot of uplift in valuations. Anything related to AI, tech, even utilities have started, obviously, to pick up from all of that energy requirement. So historically, the defensive sectors have been healthcare, staples, and utilities. And now utilities have been kind of swept up in valuation from all of this demand, this growth. So it only leaves healthcare and staples, which are quite depressed in valuation relative to the rest. So that's where I'm doing a lot of work. Sometimes we'll hold companies for years and years and years, the core of the portfolio, the Metros, the Couche-Tards. But if the market, gives us many years of returns and a fully valued stock after a few weeks, then we'll do that. And there's a few points here. So one, healthcare is interesting. I'm looking aggressively, so we might find more ideas. It might go up in terms of positioning in the portfolio. Staples is also there. The liquidity in the U.S. is quite interesting. If we go back to Liberation Day, when I bought a lot of Japanese financials,
right.
And that was mostly for, my international mandates, North Star and Global Value Long Short. So I wasn't buying excessive amounts. But some of these banks and insurers in Japan took me days to buy. There's really less and less liquidity when you go out of the S&P 500. The U.S. is really where all the liquidity is, and so that's why we're seeing quick moves sometimes in stocks that you would think are kind of liquid. They're well known. We own Nestle in large cap, and they reported this week slightly better than expected. The new CEO doing a slightly better job than expected. Stock popped up almost 10%. It's just the way of things today. There's just this disregard for anything that's not tech, AI, growth, US centric. There's less liquidity there. So for us, we need to be there before. We need to be invested there before. Or if the liquidity is there, like in the US healthcare market, we can take advantage of that too.
I was going to say, because you do have 49% outside of Canada. So going back to the liquidity comment, are you finding that to be a challenge, or I know the Fidelity Trading Desk has a lot of manpower and a lot of reach. Does that work to your favor?
It's certainly helpful to have, our amazing traders. And I do have a chat with the traders that goes on. And then that is a very active one, because over time, the process that we're following here has been attracting a lot of attention from outside. We are a partner of confidence for a lot of buyers and sellers out there. And so sometimes liquidity is a disadvantage slightly, but for us, it has become a really big advantage. So when you have to do that, you probably, you got a tap on the shoulder from whatever, the risk, or you change the portfolio manager. The problem you have is, who do you tell that to? Because if you tell somebody who might be a buyer but decides not to buy, and they have a big mouth, then eventually everybody's going to know that you're a big seller out there. So we have become a partner of confidence where I sit in Montreal and on my own. I don't like to talk to people. Everybody knows that. And so they'll call us. They'll call the trading desk and say, in confidence, we have a big block of this. So we ended up buying, 7 million shares of that at a 3% discount. We trade over half of our trades, I think, are blocks. So, we get a call, we buy 300,000 shares. If we want to sell, they're going to be blocks as well to somebody who's trying to buy. So, like I said, we let the market come to us. As the expression with the traders is, we answer the phone, we pick up the phone, we don't call anybody. Yeah. So liquidity for us, it's not as big of a deal.
That's such a great opportunity to have, though. That's a great luxury.
It is, but it's been built over 15 years.
Excellent.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to FidelityConnects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Well, let's circle back. You started touching a little bit on the global opportunity set and where we're at today. So if we're looking from the macro, there's some constraints in the U.S. We'll get to the Canadian market, but from a global perspective, you do run some global mandates. Yep. What are your thoughts around that?
Well, like I said, I think the opportunity set is a little lower than it was. We've seen revaluations in a lot of sectors. I mean, financials is a really specific one where European banks were really cheap. And they went up massively. The confidence is back. They're trading at basically at book value again. Ever since 2012, they were up and down, but the confidence was gone for a while, and now it's pretty much back. It's the same in Asia, where Chinese banks were really depressed in valuation a few years ago. Now people kind of like the dividend. Nothing bad's happening every quarter. So every quarter there's a bit more confidence, so they're going up. The Japanese banks and financials in general are doing well because inflation is just not letting up. Central bank does not want to raise rates too quickly, which is, kind of tough on the local people because their yen's going down every week because, the financial authorities don't care about the yen. They're afraid to raise rates.
And is that because of face? Like, I know that's a big thing over there. Is it about saving face with the people, or?
I think they're just, they haven't seen inflation in so long, right? And they've fought so hard for decades to fight deflation. And now that they have inflation, they're afraid to really kill it too quickly by raising rates too fast. I kind of get that angle, but from an outsider's perspective, at this point, they look a little late. And I think the currency markets are trying to tell us that as the yen just keeps going down. So all that to say, for me, there's still opportunities in China. I was there with Patrice this spring, in Japan, and we were also in France. So, I'm seeing less and less for my process opportunities outside of, Europe, really.
Okay. Well, you mentioned a great part, Europe. Might as well go there. It's a perfect segue. You've held some companies there for quite a while now, but been talking about spirits, been talking about tobacco, and those have been a great opportunity that you found in the way that we're seeing the industry shift. I know you're going to touch on this, but tobacco, you said we're going to have to rebrand to be the nicotine industry, not the tobacco industry anymore. But talk to us about what keeps you still excited to be in those spaces.
Yeah, I mean, from a big picture perspective, I think you get there naturally by thinking about what happened over the last 10 years. Growth outperformed value, U.S. outperformed the rest, big outperformed small, and everybody now thinks there's not going to be any recession for the next 2, 3, 4 years. So staples and healthcare get depressed. Obviously, more outside of the U.S. than inside the U.S. So I've naturally been attracted to those valuations from a bottom-up perspective, but it can be easily explained from a top-down. So I've been in tobacco for many years now. The story has completely changed. I mean, it was one of a really depressed valuation, misunderstood structure in the income statement from my perspective. Ever since I covered Rothmans as a young analyst in 2001, I rapidly understood that not many people in the financial industry understood the mechanics of how amazing it is to have volumes go down 5% a year and prices going up 10. You have zero spending in CapEx.
Yeah.
Your valuation is 6 times earnings, so you can buy as many shares as you want for the cheapest price possible, which means that your earnings next year just keep going up. So the algorithm here was just phenomenal for a long time. So we've made a lot of money in large cap in tobacco. There's a few years where we got a few more questions about the ESG aspect, I'll be honest, but we got through those. And now
We're here today.
And the story has changed as well, because it's now a nicotine product, like you said. The traditional cigarette consumption, at least in the developed world, is changing rapidly into one of a nicotine pouch. There was the vaping in between, which was really not any better than traditional cigarettes. But the nicotine pouch product has, everybody's trying to prove that it has to be bad for you in some way. It's like this neat little pouch made of there's pure nicotine in it that was made in a lab that you put in your mouth. Yeah. It's just exploding in growth in the last 3 years.
Well, and I think you were saying they were even trying to show some health benefits towards having it.
Well, they're trying to prove that it's bad for you. And a little bit like coffee, it's really hard, and they're actually kind of finding some benefits. 40% of U.S. Division I college athletes were tested positive for nicotine last year in one of these surveys, and they're trying to see what it could do, and it seems to increase concentration, increase athletic ability. So in some surveys or in some research, so it's really it's proven difficult to show negative impacts. And so that means that a lot of doctors are just saying, stop smoking cigarettes and switch to that at the very least, because it's definitely better than cigarettes.
Right.
So all that to say, there's been massive growth there. And so, holding like Imperial Brands that we've had for a long time, or British American Tobacco that we've had for a long time, the story has changed into one of growth now, where it used to be 0.1% of sales, and it's gone up to the point where it actually matters now. If you're having like 3% of your sales growing 150% a year, that really matters at the top line. So their multiples have gone from 6 times to 11 times over the last 2-3 years. And, even Philip Morris, which was the one first great brand there, when they bought Swedish Match, went all the way up to 25 times earnings. Wow. So the industry is really transformed, and, we made a decent amount of returns in that industry. And I think the story still is going to evolve from here.
So let's pivot to spirits then. The story behind spirits.
Yeah, spirits is a newer story. It's not years long. It's about a year plus long. But it's one that, for me, is really compelling. It has everything that I'm looking for in terms of a sector I want to be involved with. So the 3 hits against spirits companies in the last year and a half, 2 years, have been, one, the COVID overhang has hit their profitability massively, and they've had a lot of inventory because they thought that this whole COVID bump in consumption, because we were stuck inside, we all became alcoholics, we were just, renovating our kitchen. That's pretty much the only thing we could do. And so volumes exploded, and it was true everywhere. People got checks through the mail. They bought, tequila, and they were just buying champagne hand over fist. And that's really rolled over. So that's number one. Number two, young people don't drink as much. We all know that. It's really a known fact at this point. I think it's a little bit overplayed.
Yeah.
Because yes, people don't drink 8 beers anymore in a night, but what they'll switch to is buying, 2 shots of tequila, which are basically better margins for a lot of these companies. And finally, the third and really important point is the GLP-1 drug. There's a lot of, functional alcoholics out there. You might know some of them, and I know a few of them. I can't believe they can drink 2 bottles of wine every night and just completely normal. But hey, to each their own.
But
it was a really big worry.
Yeah.
It was a big worry, and every quarter that comes out, we see that it's really not that impactful.
I was going to say, you'll be standing at the bar saying what people can and
These
can't.
bars are the same everywhere. Patrice and I were in Tokyo earlier this year, same brands, all the same brands. Here, Florida, same brands. Go to my place in Montreal, same brands. It's all the same brands. They all have the distribution for it. It's all the same 3, 4, 5 companies. And so they used to trade at 50, 60 times earnings because you can't disrupt, tequila with AI. It's really difficult. And so, and if, we lose our job to AI, we'll be drinking more anyway. So it's great. These businesses are fantastic.
These are looking up.
Very resilient businesses. Nicotine pouch and, you're good for the night. So...
You're setting a really healthy lifestyle for everyone here.
Hey, I got one drink. And so, again, tonight we're going to have the same bottle. So these businesses were at 60 times earnings. I never thought we would own them in large cap ever because they were so expensive. But these 3 hits against them pushed them down. The last one, the GLP-1s, really hit them down. And so basically between 12 and 18 times earnings, good balance sheets after an inventory overhang. So these are beautiful businesses and not very cyclical. Somewhat cyclical, but not hugely. Everything's cyclical. I mean, groceries are cyclical. Everything's cyclical. Even, cell phone services and people so you're trying to find the least cyclical thing you can find. And frankly, after such a downdraft in demand, I think these businesses are unbelievably resilient to any kind of economic shock we could get.
They fit what Canadian large cap is meant to have.
Perfectly.
Absolutely. We do have a question from the audience. There have been a number of quick dips in the market due to Trump making bold claims and obviously leveraging media to do that. How do you take advantage of these periods?
Well, I mean, if the opportunity is there, if it hits my price, we'll do the move. I think this might be a good time to explain also the interaction we have with our analysts because I will take advantage of these quick dips, and we are ready, and our analysts know everything. But I think, Hugo might talk about this as well when he comes on stage. I think it's something that we talk about a little bit. The analysts, we hire the best people in Canada. We hundreds of resumes. We hire 1 or 2 people, but they haven't seen other cycles.
Right.
So we had an analyst from Toronto in the Montreal office 2 weeks ago. And it's very foreign to the younger generation that something might not be bought for momentum, for growth, but you actually have kind of a discounted cash flow view of a price that you want to pay, and you actually draw a line in the sand, even if the stock's been going down every day for 2 months and then it just gaps down on volume. Maybe that's the price I want to pay. So it's going to be fun. I'm feeling old a little bit because I'm learning. I'm teaching a whole lot of things to people, to our young analysts. But it's nice. It's really fun to interact with them. But also the fact that we have a rotational program in the analysts is good for us also to learn new things, because a new view on a sector, pushes you against what you think you know about a company. That maybe you had a new analyst 3 years ago come on the sector and you agreed with everything they said, and then this new person comes in and they completely changed and they have this new angle, something's changed, and you're like, oh wow, and it's just
new perspective.
It's a fantastic new angle that you didn't think about. So yeah, new perspectives are fun too.
Absolutely.
So we both learn from each other. But
and you've said in the past, we haven't had a recession for about 15 years, so they've only known growth. They've only known up. So
they haven't known a credit cycle. I mean, people who've gone through the COVID, month of, downdraft think they've gone through a credit cycle, but Name me a company that went bankrupt. You can't. And the government came in, saved everybody. So that's kind of the new view, that the government will always save everybody and that everything is bulletproof. And then we have one or two, bankruptcies in structured products, and now everybody's, freaking out that, oh my God, some of these were actually, double collateralized, and maybe there's more risk in these CDOs than we thought.
And you covered banks during 2008, so you have a lot to teach them.
Oh, yeah, I covered banks in '08, so unfortunately I've seen the bottom of the abyss, and it's probably made me more depressed than I should be, but I know the risks that are in these structured products very, very well.
Well, let's talk about something that has been somewhat exciting, because gold could potentially go, 4,000, 5,000?
Yeah.
We have a question here coming in. What are your thoughts around gold?
Yeah, I do have thoughts. I mean, we did have, I can't really say what we did recently. We had a small position in gold stocks earlier this year in large cap. I covered gold for many years. I ran the gold fund, so I have an opinion. I think it's pretty simple how to analyze where gold is now, and the whole thing is pretty simple to summarize. Gold is a market that has 250,000 tons. If you put all the gold in the world in one nice little cube, it fits under the Eiffel Tower. So there's really not that much around. A lot of it is in jewelry. A lot of it is in central banks. Individuals also own a lot of it, mostly in India, because of the cultural background of gold. And so, for 15 years, when people were buying and selling gold, it was kind of stable. You could figure out that based on real rates in the U.S., you could know, where the gold price should be moving. Or actually, at least it explained it. Because if you had $100 million in wealth, your choice between U.S. government bonds and gold was, well, here in U.S. government bonds, what's my real return? If rates were at zero and inflation was 3%, let's say in 2011, 12, 13, that was pretty bad. So you bought gold. But if rates are 4 and inflation is 1, then your purchasing power goes up 3% every year. So that's pretty good. So you're not going to buy gold. So that explained it for a while. Before all of that, 98 to 2002, central banks were heavy sellers. They sold 400 tons a year. They got together. They signed an agreement that they weren't going to sell more than that because it was putting so much pressure on the gold price. And the price still went below $300 an ounce, which is crazy to think about today. Now we're at the other end of that spectrum. Why? Because when Russia invaded Ukraine, the U.S. decided, I'm not sure it's a smart decision, decided to put sanctions on foreign exchange reserves of U.S. Treasury bills and U.S. bonds for up to $300 billion for Russia. And so obviously over the last few years, all the central banks around the world are thinking, well, that could happen to me too. So I might diversify a little bit. And gold is a very small pool of money and pool of assets. So that was one area they decided to go. And I think recently there's a bit of a fever around it. So it has become really difficult to predict the gold price because it doesn't follow real rates at all. It's really difficult to know where it's going to go, how aggressive central banks are going to be buying it, because they were selling it aggressively in 99, 2000, and now they're buying it aggressively. So we'll see where it goes. I'm not shorting gold in my long short fund, but I don't own really any material amount also. I think, for me, I let things come my way. I buy them when they're cheap, when they're obviously depressed. Yeah. And that's clearly not the precious metals market right now. But I understand the dynamics. But can I predict the gold price from here? No.
Okay. We only have a couple minutes left, and we have a lot to get through still, because there's a lot happening. Let's give some quick thoughts on Canadian equities right now.
There's no sector that's incredibly attractive to me. I just have to pick my spots. We have a few telecoms. We have a few food retailers. Financials have never been really my cup of tea in terms of taking risks, in part because I was the bank analyst in 08, and I know what can go wrong. And I know that when it comes to financials or structured products, there's a giant amount of assets and a giant amount of liabilities, and you have this equity is this sliver of hope between those two, and you try to analyze these two, and sometimes you misprice the assets quite materially, and so you get to a point where basically there's no equity left. So in Canada, I'm just picking ice spots. We made a decent amount of money in Saputo, which was an interesting story that I knew very well as an analyst on it in 01, 02, 03. I've been following it ever since. Never owned it, and then we started buying it last year. Empire, I also covered as an analyst, became cheap enough. We made a decent amount of money there. So, open text, boring stories that nobody's looking at because they're looking at the shiny objects of AI and large cap growth. Some of these other stocks get put by the wayside, and that's where I have to look. And right now I'm buying one every day, 2-3 basis points that I really like. Might end up in the top 10 at some point, but I think it's completely mispriced, not too cyclical. I would say one thing I've been getting better at generally, and it's proven in many positions in Canada, is to buy businesses that are higher quality at a slightly higher multiple and be more patient on the selling side. So, Max congratulated me on that a month or two ago. That really meant a lot to me, actually. Dollarama, I would never have owned 12, 15 years ago. Bought Dollarama and kept it way longer than I typically would have. And so I think if you look at the returns of large cap over the last 5 years, we've benefited not from any change in the process, but my ability slowly to improve, which was a slight weak point for me.
It's the evolution of the fund, the evolution of you as a portfolio manager.
Yeah, well, hopefully improvement.
Yeah, that's great. We need to talk about cash in the portfolio right now, though, because similar to Liberation Day, you had that liquidity, you were able to act, you were able to deploy. Maybe just a quick update on the positioning from the liquidity perspective on arbitrage. You've always been very active.
Yeah.
I think I heard we're around 25%. Is that correct? But
overall, yeah, we're a little bit over
on that.
25% in overall liquidity. Very little cash, so you won't see a cash in the holdings, but a few percentage points in bonds. But it's mostly arbitrage, which I've been involved in for 15 years. I've touched over 500 deals. So I think I'm one of the foremost experts on merger arbitrage in Canada. It is slightly lower return, slightly lower risk than a typical equity, but when you're waiting for opportunities to come your way, I think it's a great place to be. And right now the returns are pretty interesting because interest rates are a little higher than they were 10 years ago. And the spreads are, you can make, let's say, annualized 7-8%. And for those who don't really know what we're talking about here, like a very simple example in Canada is TELUS is buying TELUS International for a fixed cash price. Right. So when you have that announced, you can say, okay, there's very little left because the stock goes almost up to the price it's going to close at. There's still a few risks. There's still regulatory risk. There's still financing risk. There's still maybe shareholders won't vote for it, and then the company, maybe TELUS won't want to pay more if people vote against it. So there's always little risks like that, but they're pretty small. So that spread will be pretty tight usually. And so on an annualized basis, you can make anywhere between the T-bill rate return and the stock market return. So it's going to be like 6 to 8-ish. So it's a lot of work. Yep. And I would love not to have to do this work and for the market to be, 40% lower than where it is with a lot of great ideas for my process, but it's not where we are right now. It's where we were for about a week and a half in April. Yeah. So I went down to 0 merger arbs in April, but we rapidly cranked that up. And so the fact that, we're at 25% means I get a lot of resources, both internally and externally from the street about what deals are happening and what blocks are available. And so we're fairly active there right now, hopefully not for too long. We're
back to being patient should something happen.
Yes.
Excellent. And available and ready. We only have a couple minutes left. Let's talk really briefly about Global Value Long Short. Exciting moment for Global Value Long Short, as it has been a new building block in the multi-alt equity fund and ETF that launched on Tuesday. So if you're looking for a way to capture all of the alternative strategies in one-stop shop, this is a way to do it, a way to access Dan in that strategy. Back in April, you were covering the short book. Yep. What's the update on where you're at on the short positions today?
Yeah, I've been trying to do the right thing. So in April, covered, like you said, a lot of the short book, rebuilding these positions. And I'd say we're back to a point where, it's very, very speculative at the extreme end of the market. We're seeing, really big spikes in, meme stocks and, a few subsectors, quantum computing. They're different than 2021. I think the market cap in aggregate of these egregiously overpriced securities are bigger. And I have a watch list of basically maybe 150 names that I think are really good for shorting right now. I'm concentrating in the 20 to 40 that are most interesting. And on the flip side, I think, like I said, we have great opportunities on the long side, on the value side globally. So that fund is coiled to have decent performance at some point where if the market becomes a bit more aware of these extreme overpricings in the extreme end of the market. It's not to say that the overall market is massively, speculative, but I'd say I lived a little bit through, 2000, 2021 for sure, running that long short fund. And I do think this is kind of the biggest one, the biggest opportunity to short. So I'm very excited to be managing that fund. I do think it has a great home in Global Equity Plus and now in this new alternative fund.
And it turned 5 yesterday. How exciting. Happy fifth birthday.
Yeah, I look 10 years older though, but yeah.
It's the trade-off.
Yeah.
We have some fun questions to get to before we close out for the day. Just going back to our rapid fire. So some of you might know the answer to this, but your first job?
Oh, on the farm. So,
on the farm.
Yeah. I was. My dad was. I was 5 years old. I had jobs. Coming back from school, I knew what I had to do.
Dairy farm.
Yep.
Favorite movie?
Favorite movie? That's changed over time. I'd say recently. I'm a bit of a finance geek. It's Margin Call.
There you go. An oldie but a goodie. Love it. Go-to coffee order?
I drink a lot of espressos. If I want to go fancy, macchiato.
Love it. And a fun fact people don't know about you?
I do hot yoga every 2-3 weeks.
Do you?
Yeah.
Huh.
Yeah. I go to the gym a lot, but I've started to try to just relax somehow because these markets
That's
are just
great.
wearing on me.
You need to find it wherever you can.
That's right.
That's great. Really quickly, I know we're at time, but it has been a wild 2025. We're headed into 2026. What are you excited about? Where are you thinking it's going to lead you?
Like I said, we're going to be patient. We're going to let the market come to us. Right now, opportunities are closer in what I call the bottom of the K-shaped economy. So the bottom 50% of people are struggling more. The top 10 is doing fantastic. They're traveling the world. They're going to restaurants, booking hotels. The bottom 50 are struggling a bit more, and younger people are struggling more. So all of that to say that the movement of goods, for example, has been really, really under a lot of pressure. And so I'm very excited about like a CN Rail that we have in the holdings that moves goods, been depressed. It's been really, really tough. And I think Hugo owns a lot of them. I understand why. It's been really, really tough. The margins have been under pressure. Sometimes the multiples don't look as low as they could, but it's been such a tough 2-3 years. It just keeps going. So a lot of these stocks are getting closer and closer to buy prices for me. So that could be an exciting area for the next 6 to 9 months.
Love it. Dan, thank you for being here. Always a pleasure.
Thank you so much.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.